Welcome to Ready Set Crypto. This is your brain on blockchain. So let's face it, we've all heard of technical analysis and the indicators that it uses at some point or another. Now, one of those indicators that is definitely ubiquitous and definitely used by just about everybody out there is RSI. And while RSI can be a really powerful indicator to spot potential trades, just like technical analysis in general, it can be misunderstood and misused. Now, RSI can help you spot signals of oversold and overbought conditions and would have certainly helped you yesterday before we had the massive $800 sell-off in 50 minutes on Bitcoin. And RSI can also help you spot a potential shift in trend. You know, if you're like me, you're constantly on the lookout for these trend changes of the market. And at times like these, it's the indicators like RSI, as well as the principles taught by Elliott wave theory, that show me when to start looking for an exit. Elliott wave is really how you learn to identify trend direction with amazing accuracy, spot critical levels and where to place stops, nail tops and bottoms, and see where the market's going. It really finally just makes sense of the market structure and take the surprise out of trading. And to that end, we partnered up with another channel and an Elliott wave expert, Schuyler Edwards, who teaches our new Elliott wave masterclass. What you're about to see is one of the modules of that masterclass, and Schuyler is going to teach you how to use RSI in the context of Elliott wave theory. By the end, you should have a better understanding of how using RSI combined with Elliott wave theory application helps you to go beyond just analysis to actually making decisions. And if learning Elliott wave is at all an interest to you, consider signing up for the rest of the course by visiting us over at readysetcrypto.com/wave, because the first coaching session is starting soon, and we'll be raising the price this weekend as a result. Additionally, if you use the coupon code RSI at checkout, you'll get $10 off the course, so there's never been a better time to join, especially because we want you to be able to employ Elliott wave trading in the months leading up to the halving. So again, join us over at readysetcrypto.com/wave, and now I'll turn it over to Schuyler.
And welcome to Module 1. We're going to be going over RSI and taking this beyond the basics. So I want to challenge you to not skip over this module. It is super crucial. I can't stress it enough, the things that we're going to go over in the RSI. And I guarantee that 98% of you are going to learn something new in this module. So in this module, we're going to be going over the definition, the settings, the tactics, the divergences, and charting and relationships as well. So I've got this jam-packed with a lot of information. I'm going to pair it up with some cheat sheets as well in regards to the divergences to bring this and make it as simple as possible for you guys moving forward. But RSI is going to be our best friend when it comes to Elliott wave. Let's dive in. All right, so diving in, let's talk about RSI and the definition of what it is. It stands for Relative Strength Index, and it's a strength indicator that helps you determine the strength of the market. It's commonly known for being the indicator that tells you when the market is overbought or oversold, but there is so much more to it than just that. So when we are looking at the RSI, this is the RSI down here. I'm going to blow it up for you guys here. And the RSI is measured first and foremost between the range of 0 to 100. And then there are these white dotted lines here that are at 70 and at 30 RSI. The most basic way to use this indicator is knowing that when we're in the over 70 range, that the market is overbought and that it's typically a good time to sell. And then that when we're below the 30 RSI, we are oversold and it's a good time to buy. Now, this is the most basic concept of this tool, and there's so much more that we're going to apply to this in relationship to Elliott wave, as well as to price action too, as we advance along. So I'm going to show you a lot in this video, but you're going to learn even more as we pair it up with the future modules. So knowing that we base the strength between a range of 0 to 100, I want to show you the settings of the RSI. the settings in here, when we take a look at the settings, we have source and we have length. The source is what the strength of the market is being based off of. So you're basically plugging in this number here, and it's basing the strength of the market and giving you a reading, an indicator based off of this source. So in other words, right now we're on close, and that's the most common that you're going to see for RSI is the close. And what that means is it means the candle close. So when we take a look at price, and this is something that you're going to see so many people make a big mistake about in videos. You're going to watch people chart and they're going to talk about divergences, and you're going to watch them measure it wrong after I show you the proper way to do it. So when you're on close for RSI, it means that your plots on here are being based off of your candle close. Okay, well, think about where a green candle closes. A green candle closes at the top above the open price. Okay, a red candle closes at the bottom below the open price. So because of that, your RSI is plotting the candle close, not the candle low. Okay, it makes a big difference when you're taking a look at RSI here. And notice that the wick here, this is a green candle. Well, the low of your RSI is not being planted based off of any part of this wick right here. The RSI is being plotted based off of that red candle close right there, and then the green candle close right there. Now, in this case, the green candle close is almost literally identical to where the previous candle closed at, and so you see a flat bottom on the RSI. But take into account this example right here where the wick comes all the way down here, but the candle closes all the way up here. So when we take a look at that, this point right here on RSI is actually higher, even though it's the lowest price given the wick. It's actually plotted higher on the RSI than the red candle close right here, which is at the lowest point and gets plotted right here. Okay, so it's really important to recognize that when you're taking a look at RSI and you're measuring divergences, which we're going to get to here in a moment, that you're using red candles for measuring the bottom and you're using green candles for measuring the top when you're on the close for your source and settings. Let's take this a little bit further. Your source you can change up to open, high, low. This is in regards to your candle. So the open of the candle, the high of the candle, which is the wick, or the low of the candle, which is the bottom wick. These numbers down here are the high and the low added together, divided by 2. The high, the low, and the close added together, divided by 3. The open, the high, the low, the close added together and divided by 4. You can measure the strength of the market based off of RSI. You can measure the strength of the market based off of EMAs. And so these settings are in here. When you go into indicators, people will code in all sorts of different things that they are basing the strength of the market off of in regards to this. So you can plug multiple things in for source, just so that you understand what all of these mean. Moving forward, we are always going to be using close. And in fact, I want you to always use close so that you can build a relationship with one indicator at first. One of the biggest problems that we do is that we spend too much time learning all the different things that are out there, and we don't get good at using any one of them particularly. We don't build a relationship with actually seeing the indicator versus the price. And that's one of the biggest mistakes that we can do when we're starting out, is that we're just trying to take in all this different information, and you're not getting good at any of it. You're just a jack of all trades in that sense, okay? So we're going to use close moving forward. We're going to use the 14 length. Let's talk about the 14 length real quick. The 14 length changes up your readings. So in other words, when you get into overbought or you get into oversold, those are typically indicators that you should buy or sell. Well, when you increase your length, I want you to watch the RSI over here and how it squishes down when I double the length of the RSI. The length is your period. It's going to be based off of the time frame that you're in, but in this case here, I'm on a 15-minute time frame for price, which means that the last 28 15-minute candles are being taken into consideration to plot it against 0 to 100. Okay, so in other words, the average price of the last 28 period is when price is closing up here, it's telling you, okay, in comparison to the last 28 periods, we're in an overbought zone or we're in an oversold zone. And so what the purpose of this and how we can change it as we get more advanced. We're going to stay on the 14 for the purpose of this masterclass. But as you get more advanced, you can change it depending on the bull, if you're in a bull market or a bear market, or even your trend as well. So for example, if we go out to a daily standpoint and we take a look at this overall price here, we had 3 times that we were up in the overbought territory here, and only between this high here and this one here did we actually get divergence, so to speak. And so because of that, we can actually change up the length of this on 28. Think of it if we were on 14 now. Now look at how overbought we are in regards to the price. And what it's telling us now is it's telling us that this right here was the top, and it's giving you a sell signal here. We're going to talk about that next in regards to divergence, but I want you to understand the settings first, that when we increase the length or the period, we get less indicator of when to buy or sell. When we bring it down to a smaller time frame, we get a faster reading. So we create more noise in the market and sometimes false readings when we go lower in our length or our period. Well, this 14 can be too small of a period depending on the type of a bull run we're in. In crypto, for example, or altcoins, we get very, very bullish. And so our indicators need to be adjusted when we're in a bull run versus a bear scenario in order to compensate and not give us the too early of readings. So hopefully that makes sense for you guys. I want to dive into what divergences are now. So divergence is quite literally what it says. It's when price is diverging against your RSI. So in other words, it's reacting opposite to it. Okay, so I'm going to go down. We're on a 14 and a close for our settings. We're going to stay on that for the rest of the masterclass as we develop the relationships between price and RSI and timeframes. Okay, so don't feel overwhelmed if this is a little bit above your head right now. As we continue to go through the course, you will develop this skill and get a much better understanding of it. But I am going to kind of lay everything in regards to RSI on you right now so that you're thinking about it as we move forward and you have an understanding. So divergence, we have a bullish and a bearish divergence, and then we also have what's known as hidden bearish and bullish divergence. Another word for hidden is also continuation. That might be a better way to actually memorize it too, is continuation divergence. I'm going to show you the difference between either or. I've got a really simple way for you to memorize this as well as we dive into this. But when we're measuring bearish divergence, we're always comparing the price, the top of the price, to the top of the RSI. Okay, so bearish divergence is always the top of price versus the top of RSI. We're never going to mix the top of price with the bottom of the RSI. Okay, we don't ever measure any divergences with the top of price versus the bottom of RSI. Okay, so, and we never measure bullish divergence from the tops either. Bullish divergence is only measured and seen on the bottom of the RSI and the bottom of price. Okay, so let's talk about what a bullish divergence is and an example of it. So bullish divergence is when price creates a new low, but the RSI creates a higher low. Okay, it's really easy once you visualize it. Remember, we have to measure it by the candle closes, and on the bottoms, so anytime we're measuring bullish divergence, we're measuring the bottom of RSI on the red candlesticks. We are not measuring the green candlesticks. So in this case here, the divergence is measured from this candle low close to this candle close. We are not concerned about the green candles because we're basing our RSI off of the candle close. Okay, and green candles close at the top. So we are measuring the bottoms from here to here. Notice that price makes a lower low, but our RSI from this low here to this one here makes a higher low. Okay, that is bullish divergence and is an indicator for price to move upwards. Divergence is by far one of my favorite strategies, you guys. And when it comes to Elliott wave, it is a must to master in order to develop the proper relationships and help you determine what wave count you are in as we move forward. Let's talk about and give an example for bearish divergence. Bearish divergence is going to be when we create a higher high on price, but a lower high on RSI. Let's find an example of it here. Okay, so here's an example of bearish divergence where we have this high here on price up to this one here. And notice that we make just a slightly lower high on the RSI. Now, it's not the strongest indicator there, but in relationship to the price movement, look at how drastic that price movement was. And for the RSI not to break a new high, given that price movement, is a very bearish signal, okay? And the psychology behind it, if you think about it, is very simple. In other words, we break a new high on price, but we weren't strong enough to break a new high on the RSI. So the strength of the market decreased and is showing lower momentum, and that the market's just not that strong, even though we broke a new high. So it causes for a retrace to reset that RSI so that it can take a breather again and then try and rally again. Okay. So let's talk about, bearish divergence, just a quick recap here. Bearish divergence is when we break a higher high on price, but a lower high on RSI. Bullish divergence is when we break a lower low on price, but a higher low on RSI. And again, I'm going to have a cheat sheet attached with this for you guys to follow along with. Personally, I like to save it as a desktop background so that I can always minimize the back, and then you can always refer to it. That's how I did it when I first started out. Very simple way to not get them mixed up, and I caught on to it a lot quicker, okay? I'm also going to have some quizzes attached to this as well in order to quiz you on RSI divergences and a few examples of it so that you retain it better in your memory as well, so that you memorize it faster, okay? Let's go ahead and dive into continuation divergences, aka hidden bullish and hidden bearish divergence as well. Now, these are called hidden, honestly, because they're a little bit harder to see, but they're a very strong indicator for a trend indicator to tell you that the trend is still continuing forward and that nothing is overly, bullish or bearish about it. So let's take a look at a couple examples of these. Again, when we're bearish, we're going to be measuring the tops of price versus the tops of RSI. And this is the same when we're looking at continuation or hidden divergences. So let's take a look at this previous high back here. Let's find a good example of this here. And the 4 hour is probably going to be a little bit easier of a time frame to show this on here due to the price action that we've got here. We're going to just snap that auto there. Okay, so here's a good example of it here. So we're looking at these pivot highs here and here. Okay, and what we're seeing here is we're seeing that going from the green candle closes to the green candle close here, we're seeing that we're creating a lower high, but the RSI is creating a higher high. Okay, so it's the exact opposite of bearish divergence. The bearish divergence, we're making a higher high on price and a lower high on RSI. The only difference is with continuation is we're flipping that down. We're making a lower high on price, but a higher high on RSI. Okay, and what that says from a fundamental psychological standpoint is that the market was really strong right here. We showed really good strength in the market, but we failed to break the previous high. That is a bad sign, okay? If we are strong in the market, we should be able to break the previous high and continue upwards. And so what this is saying is that because we failed to break previous high and the market is strong, it means that we are going to continue the trend that we are in, which is we're making lower highs and lower lows. And so you can see the reaction to that. Now, something you're going to learn as we dive into this after learning about the bullish, hidden, and regular divergences is the relationship that divergences have 2 time frames, and you're going to develop that skill as we move through the masterclass. But I'm at least going to plant the seed in your head as we move forward here. So let's talk real quick about hidden bullish divergence. Hidden bullish divergence is going to be the exact opposite again of regular bullish divergence. So let's take, for example, this move here. We had red candle close to red candle close. We had a lower high and higher low on RSI. So this is a regular bullish divergence. So a continued bullish divergence or hidden bullish divergence is just when you're making a higher low on price, but a lower low on RSI. So let's go ahead and find an example of it. This is probably, given that we're in a retrace from 14K in Bitcoin here, we're probably going to be looking a little bit easier on a smaller time frame in order to see this, because it's going to be more of a counter trend. So given this run up here, we should be able to see a hidden bullish divergence in here in order to indicate that this trend is going to continue. So if we look at our pivot lows, we're taking a look at this here. So here's an example, and it's a slight example, but it's all you need sometimes. So at least in this case here, this is going to be good enough. So right here, we've got our lowest red candle is right here, and then the next one is right there. So notice that we make a higher low for this pivot in regards to price, but look at the difference on our RSI. We have a lower low on our RSI drastically. So this is known as hidden bullish divergence. Let's do a recap real quick, and let's see if we can't find just one more here. So here again is another one. Okay, so we've got lowest red candle close there to lowest red candle close right there. Remember, we're not going based off of the wicks here. Just candle closes that the RSI is concerned about. And notice that we make a much lower low on RSI. This is hidden bullish divergence. Shows that we're continuing the trend. The trend is strong. Okay, so quick recap here. Bearish divergence is when we make a higher high on price, but a lower high on RSI. Hidden bearish divergence, also known as continuation, is when we make a lower high on price, but a higher high on RSI. Going to bullish divergence, regular bullish divergence is when we make a lower low on price, but when we make a higher low on RSI. Vice versa, continuation, aka hidden bullish divergence, is when we make a higher low on price, but the RSI makes a lower low, resetting it. Okay, so the next thing that I want to show you to end off this module 1 here is going to be the relationship between RSI and timeframes. And I'm going to plant this seed, but it is so powerful for you guys to be able to build this relationship with timeframes and RSI as we move forward. I'm going to make it real simple because I've done a lot of the work already through my trading style to develop the relationship here. For me, I like to go in between the 4-hour and the 15-minute time frame. And the relationship that has been built between the 15-minute time frame and the RSI in relationship to the 4-hour time frame is that on a 15-minute time frame, we will see a divergence. And for example, a bearish divergence in a correction or in a bear market will typically play out anywhere from about 1.5% to 3%. Whereas a bullish divergence in a uptrend will typically play out anywhere between 5 to 7% on the 15-minute time frame. So it depends on the trend that you're in, and it depends on the time frame that you're in, that you develop a relationship to understanding just how big of a reaction you can get depending on the divergence and the time frame you're on. Another example is on the 4-hour. When I see a 4-hour divergence, it typically plays out anywhere from about 12 to 15%. When a daily divergence plays out, it's typically anywhere from between 20 to 22% of a move. So being able to recognize how much of a reaction your price gets based off of the trend you're in and based off of the time frame you're in is extremely significant in order to develop your Elliott wave count, but also help you determine what subwave of an Elliott count you're in as well. And you're going to learn more about that as we move forward. All right, so that's all I want to bring into this masterclass for Module 1, you guys, in regards to RSI. I hope that you've learned a few things. I will see you for the next Module 2. I'm excited to be diving into that. And go check out the cheat sheets and make sure to take care of the quiz as well. That's going to be attached to the RSI module here so that you retain all of the information that we just talked about a little bit better. All right, see you in Module 2.